Jamie Dimon, the CEO of JP Morgan, just issued a dire warning about the state of the US economy as well as the out of control spending that's going on by the US government. And this warning is something that you all need to pay close attention to because it highlights the significant downside risks to both the economy and financial markets in America that so many people are mistakenly ignoring right now. With Jamie Dimon issuing this warning in his letter to shareholders of JP Morgan, that's the US's largest bank, he warned of 8% interest rates to go along with a recession. Now, before getting into what exactly Jamie Dimon had to say and the specific points he brought up, understand that this is the CEO of America's largest bank. JP Morgan's worth over $500 billion in market capitalization. They have over $2 trillion of your deposits sitting at their banks. So Jamie Dimon, he's very hooked into the economy. He sees what's going on, and this is what he's warning of. He's saying that the odds of a Goldilocks soft landing outcome for the economy are a lot lower than the consensus of a 70 to 80% likelihood. In addition, he coupled that with concerns about the potential for stagflation, a recession characterized by lingering high inflation, and he warned that interest rates could soar to 8% or even more. And so he's saying that, hey folks, a lot of people are thinking that this recession, it's not going to happen, it's over, soft landing. He's saying, hey, that's not maybe such a wise perspective because there's still big risks. And one of those risks is that interest rates, rather than going down, could actually go up. So there's lots of people right now who are expecting the Federal Reserve to cut interest rates over the next year and save the economy and save the housing market. But more and more those rate cuts are looking less and less likely. The point now that projections for the federal funds rate by the end of the year have it going down to only 4.8% based on what the betting markets are predicting the Fed's going to do. So we're really shifting to a base case of only 2 rate cuts through the end of 2024. But what Jamie Dimon is saying is, hey, wait a minute, folks. Like, if we look throughout history, interest rates in America, if we go back to the 80s and 90s, were much higher than this. They were in the 8% range. They were in the 9% range. They were even in the 10 to 11% range in the mid-1980s. So don't be surprised if these interest rates might even take a surprise turn upwards in future months and years. And the reason that interest rates might actually go up instead of down in Jamie Dimon's eyes is because he sees persistent inflationary pressure across the economy. Jamie Dimon does not seem to believe that inflation is going to keep going down. Rather, he thinks that there's structural forces at play related to sky-high deficit spending from the US government, related to deglobalization, related to a lack of investment in energy infrastructure that are going to lead to persistently higher inflation figures. Dimon explained that these persistent inflationary pressures could keep prices sticky, and that if this higher rate scenario were to play out, there could be huge carnage for both equity and debt investors as stock valuations are already at their high end and credit conditions are extremely tight. And so the takeaway here for you as a home buyer or an investor, or just someone interested in the economy and stock market, is that there's huge downside risk that lots of people are ignoring right now. Somehow, just because this recession hasn't hit in full force, or just because the stock market keeps going up, lots of people somehow think that the underlying fundamental factors that are destined to slow the economy are somehow, not here, or that they've gone away. But they haven't, everyone. Interest rates are at a 20-year high, and they're not going down nearly as fast as people would like. And one of the reasons that interest rates aren't going down, and one of the reasons why you still have to pay 7% for a mortgage if you buy a house, is because the US government keeps spending money like a drunken sailor. The deficits and the debt, they just keep going up by the day, by the month, and by the quarter. And as the US government keeps borrowing this money, it's going to keep putting upward pressure on interest rates and inflation and make it extremely difficult for inflation and interest rates to come down. It has to do with this US government debt bubble, which I previously had as the $33 trillion debt bubble. Well, now it's up to $34 trillion, everyone. At the end of 2023, we had $34 trillion in federal public debt. Now, I know that number sounds high, but let's just get some context for this. Back before the pandemic, our debt was $23 trillion, meaning that in a matter of 4 years, the debt increased by almost 50%, which is shocking, everyone. And it's this raging debt that is ultimately keeping the economy afloat. The more money that the US government borrows, the more money it can push out into the economy. Very important for you all to understand this. The fact that, the unemployment rate in America is still only 3.8%, the fact that the stock market's still at a high level, and the fact that the housing market hasn't really hit the major crash yet, it's all due to the fact that the government keeps pumping money into the economy. And the way to understand just how egregious this government spending is, and how this is going to actually be really bad for America in the long run, is to look at this graph, which compares on the top how much we're spending as a country to how much we're taking in taxes. So right now, we're spending about 6.7 trillion a year as a country. Meanwhile, we're only taking in 4.8 trillion in taxes, which creates a roughly $2 trillion deficit. And it's this deficit accumulated year by year, which adds to the debt. The only other times we've had this type of deficit spending were in 2008, 2009, during the worst recession in 70 years, as well as during the pandemic. Other than that, there's no precedent for this type of deficit spending. And what I believe, and I think what Jamie Dimon believes, is that the current state of the economy has been heavily influenced by this artificial injection of spending, and that at some point there's going to be a comeuppance. There's going to be a shift where all of a sudden this is not really tolerated by the markets and by the economy anymore. Don't just blindly buy the narrative that everything is fine and that we're in a Goldilocks scenario. Because when you look under the hood, there are problems, big problems that are being masked by artificial government spending, as well as a big surge in immigration. Because this is the other thing that's keeping the economy afloat, and something that a lot of people are now talking a lot more about. Jerome Powell, the head of the Federal Reserve, recently came out and said that higher immigration levels are one of the things that are actually supporting the US economy right now. And the reason is simple, is because the more people there are in the economy, the more our population is growing, the more people there are to spend money, and the more people there are to cause GDP to grow. Additionally, the more people that come to America via immigration, the more people who are going to have a job. Pay attention to this, because this graph explains exactly what's going on in the job market right now. It compares two lines. One is the blue line, which tracks the employment level of foreign-born workers in America. You can see that there's now 31 million employed foreign-born workers, which is significantly higher than the 28 million prior to the pandemic. Now, at the same time, the employment level of the native-born population in America, people who were born in this country, is 130 million. So there's way more people who are employed who are born in America than who came to America via immigration. However, note that the employment level of native-born Americans is actually lower today than it was prior to the pandemic. So we actually have a contraction in employment for native-born Americans to go along with a boom in employment for foreign-born Americans. And this is ultimately what is keeping the labor market afloat. That data I showed you, that's taken from the Bureau of Labor Statistics. That's government data showing you the huge disparity in employment growth between foreign-born workers and native-born workers. And I'm going to talk about that in 1 second, what all of that means for the economy in the short and long term. But first, I want to get back to Jamie Dimon and explore a couple of the other things that he said in his annual shareholder letter to the shareholders of JP Morgan, because there's a lot of interesting stuff in there. In this shareholder letter, he talked about a lot of different things. He also showed stats on JP Morgan's growth, which is actually kind of crazy. You can see that when he took over JP Morgan, shortly thereafter, they had 187 billion in deposits. Now they have 1.1 trillion in deposits. So JP Morgan, they have 11% of all the banking deposits in America, which is kind of crazy. They're a really big bank. But what he said was kind of interesting. If you scroll further down, folks, take a look at this. He's talking about how the banking crisis of 2023 is over. He says that the crisis is over provided that interest rates didn't go up dramatically and that we didn't experience a recession. However, if long-run rates go up over 6% and this increase is accompanied by a recession, there will be plenty of stress, not just in the banking system, but with leveraged companies and others. Remember, a simple 2 percentage point increase in rates essentially reduced the value of most financial assets by 20%, and certain real estate assets, specifically office real estate, may be worth even less due to the effects of recession, higher vacancies. Finally, we should also consider that rates have been extremely low for a long time, and it's hard to know how many investors and companies are truly prepared for a higher rate environment. And so again, we don't know where interest rates are necessarily going to go over the next 1 to 2 years. The Federal Reserve, they think they're going to cut rates 2 to 3 times this year, but more and more, the data in the labor market and the inflation data is suggesting maybe they're not going to be so quick to cut. And if the inflation data stays persistently high, this could push up long-term bond yields and eventually force the Fed to abandon their hope of cutting rates, which could cause lots of economic problems, especially for banks and especially for real estate investors, everyone. I want to actually close out this video with some analysis for real estate investment and why I actually think that now is not a good time to buy real estate as an investment. Particularly for rental cash flow. And the main reason is because these interest rates, even at current levels, they choke off your ability to make money as a real estate investor. And let me show you guys what I'm talking about. Even if you're not an investor, pay attention to this because you might be competing with an investor to buy a house. And I want you to understand the dynamics that these investors are facing. But we have 3 lines on this graph, and I want you to pay attention to all of them. They're very important. First is the orange line, which is the cap rate, or the unlevered profit for a real estate investor buying a house in America and renting it out. The average real estate investor gets about a 4.5% return from buying a house, renting it out. That is much lower than it was 10 years ago when it was 5.5%. But this trend in lower cap rates and returns, it was actually fine for a while because the interest rates, the yellow and the blue line, were low. The yellow line is the 10-year treasury, the blue line is the 1-year treasury. And you could see basically from 2011 all the way through 2022, the cap rates and the returns for investment properties were way higher than the interest rates. However, since late 2022, we've seen a market shift. Now, all of a sudden, into 2024, you can get more money by buying a 1-year US Treasury than you can by buying a house and renting it out. But not only that, the 10-year Treasury yield, the long-term bond, is now almost at the same level, 4.2%, 4.3% compared to 4.4% on the cap rate. And this long-term bond is actually really the big one because this is a 10-year government bond, and that more or less corresponds to the duration that a lot of real estate investors look at when they buy a house. Right? So if you can get a 10-year return of 4.2% a year, wow, that's kind of compelling compared to having to go buy an investment property and barely make any money. And ultimately, this is dollars and cents, everyone. This is, again, the US government competing with private investment and enterprise. Because the US government keeps borrowing so much money, it's pushing the interest rates up, particularly the long-term interest rates, making it harder to earn a return in other businesses like real estate investment. And I actually just want to show you guys a concrete example of this and why a lot of investors in the housing market are having problems right now. And to understand this, let's look at this rental. This rental here is in Phoenix. It's a rental from Tricon, which is one of the big Wall Street investors. They actually just bought by Blackstone. They have this 3-bed, 2-bath house on the market for rent outside of Phoenix for $2,000 a month. Now, if you're a real estate investor, you got to ask yourself, is this a good rental rate? Well, to answer that question, you got to compare that to what you would have to pay to buy that house. And you could see a similar house in the same neighborhood, a 4-bed, 2-bath, 1,800 square feet, is currently on the market for $450,000. So $450,000 to get $2,000 a month in gross rent. Is that worth it? Well, let's take a look at the numbers. See, I put together this rental pro forma based on this hypothetical investment property. If you purchase this property for $450,000 and then rent it out for $2,000 a month, you'd get $24,000 a month in gross rent. Now, after that gross rent, you got to deduct your expenses. We got the vacancy and credit loss expense, which I have at 6%. Additionally, you got $1,800 a year in maintenance and repairs, $2,100 a year in taxes, $1,200 in insurance, $1,900 a year in property management expenses for net income of $16,000 a year. $16,000 a year on this property on a purchase price of $450,000, which nets you a 3.5% cap rate, which is even lower than the US average cap rate I showed you. So in this hypothetical example, we just did the rental pro forma for this Phoenix market, and you're only getting a 3.5% return if you buy an investment property at today's prices and rent it out at today's rental rates. That's not very good. That's almost 1.5% lower than the 1-year US Treasury. But folks, what gets even crazier is that's just from an unlevered perspective. That's assuming there's no debt on the property. However, almost every real estate investor is going to finance it with debt somehow, whether it's through a mortgage or through some type of credit facility. Well, if you were to take out an 80% mortgage on this property to buy it at a 6.9% mortgage rate, your monthly payment would be $2,400 a month, which is more than the rental rate, which is not a good sign. your annual payment would be $28,000 a year, meaning that your cash flow after debt service would be minus $13,000. So if you subtract the $16,000 in income from the $28,000 in your mortgage payment, you're having to come out of pocket $13,000 a year to float this investment property, which is why so many investors have dropped out of the market. It just does not make financial sense. And I don't think we're going to see real estate investors re-enter the market until home prices go down substantially. Because home prices going down substantially, it's really the only way to make these properties profitable again. Because for instance, if this property was worth $250,000, if there was a 44% haircut on the purchase price and the rental income and net income was the same, that would make the cap rate 6.3%, which is much more palatable, much more attractive, and would actually allow you to at least break even if you use the mortgage at today's interest rates. And that example right there for real estate investors, it's a great example for why the economy overall is going to have a difficult time withstanding these interest rates if they continue to stay in the 5.5% range on the Fed funds and 7% range on the mortgage rate. If they continue to stay at that level, problems will arise. And boy, if Jamie Dimon is right, and if there's a risk factor that interest rates could go up even more in the future due to higher inflation, then I think all bets are off on what could happen in this economy. So very important for you guys to understand that the fundamentals are still very, very shaky in the economy, in the housing market, in the stock market. And that there's lots of people out there who want you to ignore that because they want you to just get like FOMO'd into whatever thing they want to sell you. And so I hope you guys enjoyed this video. Let me know in the comment section below what you thought of it and what you think about what Jamie Dimon is saying about the economy and what you think about JP Morgan, as well as the prospect of higher interest rates instead of lower interest rates in the long run.